Ladies and gentlemen, lean in, because moments like this don't announce themselves twice. History doesn't knock politely, it whispers first, and then it roars. Today, we are staring straight at one of those whispers. A leaked recording, a panicked executive, and a supply chain truth so explosive it threatens to rewrite the rules of global markets. This is not gossip. This is not theory. This is a warning signal flashing red in a system built on confidence. When the CEO of a global manufacturing titan like Samsung is caught in a moment of raw concern, the smart listener doesn't laugh, it listens carefully. We are told that everything is under control, that inventories are sufficient, that markets are liquid. But let me ask you something powerful. If everything is fine, why is panic leaking out behind closed doors? Why is the conversation suddenly about a 50 million ounce silver shortage? And why, in the same breath, do we hear that COMEX, supposedly the deepest silver market in the world, may be holding barely 5 million ounces of deliverable metal? That gap between reality and reassurance is where crises are born. Silver is not a luxury metal anymore. It is not just jewelry, coins, or collectibles. Silver is infrastructure. Silver is technology. Silver is energy. It is inside every semiconductor, every electric vehicle, every solar panel, every data center powering the digital world. When a company like Samsung, at the heart of global electronics, signals concern, it's not about price speculation. It's about production survival. No silver means no chips. No chips mean no devices. And no devices mean the modern economy starts to stall. Here's the hook most people miss. Shortages don't begin when shelves are empty. Shortages begin when trust breaks. COMEX was built as a promise that paper contracts could always be exchanged for real metal. But what happens when paper claims multiply while physical supply shrinks? What happens when 50 million ounces are needed and only 5 million are visible? That is not a market imbalance. That is a credibility crisis. And markets run on belief long before they run on metal. Think about the psychology of this moment. Executives don't panic in public unless the problem is already late stage. They panic in private first, they whisper in boardrooms, they make emergency calls. And when those conversations leak, it's because pressure is cracking the walls. This is how supply shocks announce themselves, quietly, then suddenly. Overnight, a manageable issue becomes a bidding war for physical delivery. Overnight, contracts are questioned. Overnight, price is no longer set by screens, but by whoever actually has the metal. The reported 50 million ounce silver shortfall exposes a structural imbalance that has been quietly building for years beneath the surface of global commodity markets. On one side sits the physical market, constrained by geology, mining timelines, refining capacity, and logistical realities. On the other side sits the paper market, where futures contracts, options, and unallocated positions can be created in volumes that far exceed the amount of metal that actually exists for delivery. This divergence is not a theoretical concern. It becomes critical the moment confidence is tested. When market participants begin asking whether paper claims can truly be exchanged for physical metal, the entire pricing framework comes under pressure. The hook most observers miss is this: paper liquidity can expand infinitely, but physical silver cannot. A futures exchange may show millions of ounces trading hands in seconds, yet those transactions do not move a single bar of metal unless delivery is demanded. As long as most participants roll contracts forward, the system appears stable. But when even a small percentage insists on delivery at the same time, inventories that look sufficient on paper suddenly appear dangerously thin. This is where a reported 5 million ounces of deliverable inventory becomes alarming when set against a 50 million ounce industrial need. What makes this imbalance especially dangerous is the illusion of price stability it creates. Prices formed in paper, heavy markets often reflect leverage, sentiment, and financial positioning rather than true scarcity. This delays the market's natural response to shortages. Instead of prices rising early to ration demand and incentivize new supply, the adjustment is postponed. When the correction finally arrives, it tends to be abrupt and disorderly. The market doesn't gently reprice, it gaps. That is how shortages turn into shocks. Another critical dimension is counterparty risk. A paper contract is only as strong as the system backing it. If too many claims chase too little metal, settlement pressure increases, forcing exchanges and counterparties to choose between cash settlement, rule changes, or emergency interventions. Each of these outcomes further weakens confidence. Once trust erodes, participants no longer ask about price first, they ask about availability. And when availability becomes the priority, The rules of valuation change overnight. This dynamic explains why sophisticated buyers are increasingly bypassing exchanges in favor of long-term offtake agreements and direct sourcing. They are not speculating, they are ensuring continuity. The moment industrial users shift behavior from price optimization to supply security, the paper market loses its dominance. That transition is subtle at first, almost invisible, but once it gains momentum, it accelerates rapidly. By the time headlines acknowledge the imbalance, the physical market has already tightened, premiums have already risen, and the gap between paper pricing and real world cost has become impossible to ignore. Industrial silver demand operates under a fundamentally different economic logic than consumer or investment demand, and that distinction becomes critical during periods of supply stress. For high-technology manufacturers, silver is not an optional input that can be substituted or delayed when prices rise. It is a functional necessity embedded deep within production processes, from conductive pastes in semiconductors to high-efficiency contacts in advanced electronics. When companies like Samsung plan output, they do not ask whether silver is affordable, they ask whether silver is available. That single distinction is what turns a routine supply imbalance into a strategic vulnerability. The hook that reshapes this discussion is simple but powerful. Inelastic demand does not respond to price signals in the way textbooks assume. Classical models suggest higher prices reduce consumption, restoring equilibrium. In industrial silver markets, that mechanism breaks down. A marginal increase in silver costs has little impact on the final price of a smartphone, data server, or power management system, but the absence of silver halts production entirely. Faced with that reality, manufacturers absorb higher costs rather than risk operational shutdowns. Demand therefore remains firm even as prices rise, intensifying pressure on limited supply. This inelasticity is amplified by the scale and synchronization of modern manufacturing. Global electronics supply chains operate on precision timing, lean inventories, and just-in-time delivery. There is no buffer for prolonged shortages. When silver inputs are disrupted, the effects cascade rapidly through fabrication plants, assembly lines, and downstream suppliers. Missed production targets are not easily recovered, and lost market share is often permanent. That makes securing raw materials a board-level priority, not a procurement detail. Another overlooked factor is the lack of immediate substitution. While research continues into alternative materials, performance trade-offs, reliability issues, and regulatory approvals prevent rapid adoption. In advanced electronics, even minor changes in conductivity or thermal behavior can compromise product integrity. This locks manufacturers into silver-intensive designs long after prices begin to rise. In economic terms, demand remains rigid while supply remains slow to respond, creating sustained upward pressure rather than a temporary spike. As awareness of this constraint spreads, behavior changes before official data reflects it. Long-term contracts replace spot buying. Strategic stockpiles quietly expand. Firms compete not just on product innovation, but on access to raw materials. This is where price becomes secondary to certainty. Once industrial buyers shift from optimizing margins to safeguarding continuity, the market enters a new phase. Silver stops behaving like a traded commodity and starts behaving like a strategic input, where availability defines value more than quoted price ever could. Confidence is the invisible architecture of every financial market, and nowhere is that more evident than in commodity exchanges built on inventory reporting and delivery promises. Participants do not physically inspect vaults before trading, they rely on published data, standardized rules, and the assumption that claims are backed by verifiable assets. When questions arise about the accuracy, accessibility, or sufficiency of reported inventories, the market's foundation begins to weaken long before any official shortage is declared. Transparency is not a courtesy in this system, it is the currency of trust. The critical hook is this: markets do not collapse when inventory hits zero, they destabilize when belief does. Even rumors of inadequate deliverable supply can trigger behavioral shifts that overwhelm the system. Traders who once rolled contracts forward begin requesting delivery. Institutions that were comfortable with unallocated exposure suddenly seek allocated metal. Each of these decisions, rational on its own, compounds pressure on inventories that may already be thin. What looked like ample supply under normal conditions quickly reveals itself as conditional supply, dependent on continued confidence. Inventory opacity accelerates this process. When reporting categories are complex, delayed, or poorly understood, suspicion fills the gaps. participants begin to discount official numbers, applying their own risk assumptions. That discount shows up first as higher premiums, wider spreads, and declining willingness to sell physical metal. Liquidity appears to exist, but it becomes increasingly one-sided. Buyers line up, sellers step back. This asymmetry is one of the earliest indicators that confidence is eroding. As trust weakens, the market's priorities shift. Price discovery gives way to delivery assurance. The question changes from, what is silver worth? To, can I actually get it? This shift has profound implications. Exchanges and counterparties face rising settlement risk as delivery requests increase relative to available inventory. To preserve system stability, rule changes, cash settlements, or position limits may be introduced. While intended to calm markets, such measures often have the opposite effect, reinforcing the perception that physical constraints are more severe than acknowledged. The feedback loop becomes self-reinforcing. Reduced confidence leads to higher delivery demand, which further strains inventories, prompting additional concern. Participants with the means to secure metal outside the exchange do so, draining liquidity from the very system designed to provide it. Meanwhile, those unable to access physical supply remain exposed to paper claims whose reliability is increasingly questioned. What makes this dynamic especially dangerous is its speed. Confidence can take years to build and days to unravel. Once transparency is doubted, restoring credibility requires not assurances, but proof, visible metal, timely delivery, and consistent reporting. Until that proof is unquestioned, the market operates under a persistent risk premium, one that reflects not just scarcity, but uncertainty itself. Silver's deep integration across modern industries transforms what might appear as a narrow supply issue into a system-wide economic vulnerability. Unlike commodities tied to a single sector, silver sits at the intersection of electronics, energy, transportation, defense, and communications. When availability tightens for one major industrial buyer, the shock does not remain isolated. It ripples outward, affecting multiple value chains simultaneously. This concentration of dependence is what turns a supply disruption into systemic risk rather than a temporary inconvenience. Here is the hook that reframes the issue. The more technologically advanced an economy becomes, the more fragile its dependence on specific inputs grows. Silver is embedded in semiconductors, power management systems, solar cells, medical devices, and advanced military hardware. A shortage does not merely raise costs, it threatens output continuity. When a large manufacturer begins competing aggressively for supply, smaller firms are pushed aside, creating uneven access across industries. This imbalance distorts production schedules, amplifies bottlenecks, and forces prioritization decisions that reshape entire markets. Systemic risk intensifies because these industries are interconnected. A disruption in semiconductor manufacturing delays consumer electronics, data centers, automotive production, and industrial automation. Those delays feed into employment, logistics, and capital investment decisions. What begins as a raw material constraint becomes a macroeconomic variable, influencing inflation metrics, growth forecasts, and corporate earnings. The market often underestimates this transition because it occurs quietly through missed shipments and revised guidance rather than dramatic headlines. Another layer of vulnerability lies in geographic concentration. Many silver-dependent industries rely on globally distributed supply chains, while mining and refining remain regionally constrained. This mismatch increases exposure to geopolitical tension, trade restrictions, and regulatory shifts. When supply security becomes uncertain, firms respond defensively by stockpiling and locking in long-term contracts. While rational at the firm level, this behavior tightens availability for the broader market, accelerating scarcity dynamics. The feedback loop is powerful. As industries scramble to secure inputs, prices rise, but production does not immediately expand due to long development timelines. Capital investment in new supply lags demand by years, not months. In the interim, the economy absorbs the shock through higher costs, delayed innovation, and reduced flexibility. The risk is not that silver disappears, but that access becomes uneven and strategically contested. This is why silver shortages command attention beyond commodity desks. They represent stress fractures in the architecture of modern industry. When a single material underpins so many critical systems, its disruption becomes a multiplier of risk. The real danger lies not in any one factory slowing down, but in many sectors slowing together, quietly transmitting strain through the entire economic framework. When physical availability tightens, the authority to set prices quietly migrates away from financial exchanges and toward those who control real supply. This transition does not happen with an announcement. It unfolds through behavior. Futures markets may continue to quote prices, but those prices increasingly reflect financial positioning rather than transactional reality. The true signal emerges elsewhere, in delivery delays, rising premiums, and private negotiations conducted far from public screens. This is the moment when price discovery begins to fracture. The key hook is this: markets do not lose relevance when trading volume disappears. They lose relevance when delivery becomes optional. In a functioning commodity market, futures prices anchor expectations because participants believe contracts can be settled with metal. As physical scarcity grows, that assumption weakens. Buyers who require immediate supply stop relying on exchange mechanisms and turn to direct sourcing. They pay what is necessary, not what is quoted. That divergence creates two markets, one visible and one decisive. Bilateral contracts and off-exchange transactions gain prominence because they offer certainty. Industrial consumers negotiate long-term supply agreements that prioritize volume and timing over short-term price optimization. These deals often include premiums, escalation clauses, and non-public terms, reflecting the real cost of securing metal under constrained conditions. As more demand migrates into these channels, exchange liquidity becomes increasingly dominated by speculative flows rather than end users. The quoted price remains active, but its informational value declines. Volatility rises as a result. With fewer physical participants anchoring trades, prices become more sensitive to sentiment shifts, macro headlines, and positioning changes. Meanwhile, physical premiums tell a different story, signaling scarcity even when futures prices appear stable. This disconnect confuses observers who rely solely on headline prices, delaying recognition of underlying stress. By the time futures adjust, much of the repricing has already occurred in the physical market. Another consequence is the erosion of arbitrage. Under normal conditions, discrepancies between paper and physical prices invite corrective trades. During shortages, those trades become risky or impossible due to delivery uncertainty. Without effective arbitrage, mispricing persists. The market fragments, and trust in centralized pricing weakens further. As this shift deepens, the role of exchanges changes. They remain useful for hedging and financial exposure, but less so for sourcing material. Pricing power consolidates among producers, refiners, and holders of inventory. Value becomes defined by possession rather than promise. This is not a temporary distortion, it is a structural response to scarcity. Once participants learn that physical control trumps contractual claims, behavior adjusts accordingly, and the market does not easily revert to its prior state. Signals of market stress rarely arrive through official statistics or polished press releases. They emerge first through behavior at the highest decision-making levels. When executive concern surfaces, especially in the form of leaked discussions, it reflects internal assessments that have already moved beyond routine risk management. Senior leadership does not speculate casually. Their focus is continuity, exposure, and worst-case scenarios. When those conversations point toward resource insecurity, the market is often already late in the cycle, even if prices have not yet reacted. The hook that sharpens this reality is simple strategic repricing begins in boardrooms, not on trading screens. Before analysts adjust forecasts or institutions rebalance portfolios, executives reassess the role a resource plays within their operations. Silver, in this context, stops being viewed as a cost input and starts being treated as a strategic asset. That shift alters procurement strategies, capital allocation, and long-term planning. It also quietly changes how value is perceived, even if public pricing mechanisms lag behind. This early stage repricing is subtle. It does not immediately translate into dramatic spot price moves. Instead, it appears through non-price signals, longer contract durations, prepayments, supply guarantees, and willingness to accept higher fixed costs in exchange for certainty. These behaviors indicate that decision makers are discounting future availability rather than present price. In economic terms, expectations are changing, and expectations drive markets long before equilibrium data confirms the shift. Another defining characteristic of strategic repricing is asymmetry of information. Insiders closest to supply chain see stress first. They observe delayed shipments, reduced flexibility from suppliers, and tighter contract terms. Public markets, by contrast, rely on aggregated data that updates slowly. This gap creates a window where perception and reality diverge. During this phase, assets tied to the constrained resource remain undervalued relative to their future role, while the risks of disruption are underappreciated. As awareness spreads, repricing accelerates. What was once a procurement issue becomes a strategic discussion at the national and sector level. Policymakers, defense planners, and energy strategists begin to classify the resource as critical infrastructure. That designation further alters demand behavior, reinforcing scarcity through stockpiling and preferential access. The market transitions from cyclical pricing to strategic valuation, where availability, security, and resilience carry premiums independent of marginal production costs. Once a resource enters this phase, it rarely returns to its prior status quickly. Strategic value reshapes incentives across the entire ecosystem, from exploration investment to recycling and substitution research. The initial signals may seem quiet and indirect, but they mark the inflection point. By the time repricing becomes obvious in headline numbers, the underlying shift has already occurred, driven not by speculation, but by the decisions of those responsible for keeping complex systems running. So here is the takeaway: strong, simple, and unavoidable. When leaders panic in private, prepare in public. When supply chains whisper, listen before they shout. The leaked recording is not the event, it is the signal. The signal that silver is no longer abundant. The signal that paper promises are being tested. And the signal that the next phase of this market will be decided by reality, not reassurance.